Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of March 9th, 2025. And in this week's episode, we are going to talk about perseverance and sticking to the plan. That is one of the hardest things to do in trading, in my opinion, because in the heat of the moment, in the emotions, they're going to run high, and you're going to want to abort your plan, either because it's going really bad or because it's going really good. And you're going to think, I'm going to be clever, and you're going to modify your plan. And I'm here to go through an example on coin that recently traded with me. It was a long trade that went well against what I had thought in the ideal, and show that when you stick to the plan, there's a reason you have a plan, and there's a reason as to why you stick to it. And so I'm going to talk through that in this week's episode. Also want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up there, subscribe, and if you can't find it, let us know, and we will get it there. But let's hop to this week's content. And in this week's content, I want to talk about sticking to the plan. And as I mentioned in the intro, sticking to the plan is one of the most difficult things to do in trading, in my opinion, because your mental brain is going to play games on you when you are in the heat of the moment, when you are in the middle of the trade, and the trade is going either wildly in your favor or wildly against your favor. You're going to be very, very tempted to abort your plan and try something else. If it goes roughly, close to what you wanted, it's a lot easier to stick to the plan. But I want to talk you through and show you a recent example of where I had a plan of selling some theta, and the stock moved wildly against me, to the point of one of the largest drawdowns on a single trade that I've had. Not the largest, but it was definitely up there. I want to talk you through what did I do to kind of defend that, and how did I stick to the plan, and how did it work out in the end. So before I bring up the chart of the play, basically I am a premium seller. So I like to sell options and collect the premium. And the ones that I target are ones that have a lot of extended volatility, where the volatility in the option is much larger than is normally there. And I sell it looking to short the volatility, thinking volatility is going to come down. It's going to revert to a mean. And when it does, the premium will evaporate, and I will then close it out for a much lower price than what I sold it for. And one of these things was going into the U.S. election on Coinbase, ticker Coin, and Coinbase is a cryptocurrency trading platform. And going into the U.S. election, the crypto everything was incredibly volatile. So I thought, great, this is going to be like easy money. U.S. election, binary event, volatility is going to disappear. I'll sell it all pre-election. I'll buy it back after the election. All the volatility be gone. I'll make bank in a couple of days. That was not the case. And so we're going to go ahead and take a look at the chart here of what actually this looked like in my Flappy Bird chart. Now, the Flappy Bird chart has got a bunch of red boxes, and each of these red boxes are a particular option that I sold. And anytime the chart moves into those red boxes, that is bad for me. It means they're in the money, and it's going to put a drawdown on my account. So this first red box, you'll see one on the top side, one on the bottom side. This was my very strangle that I opened. About a 155 put and about a 240 call. And I was saying, look, we got all this volatility. We're right here in the middle. Election's going to come. Nothing's going to be happen, and volatility will come out. But you can see right here, this green rocket just absolutely blasted up, punched straight through my strike after the U.S. election, hung out here for about a day. And I thought, okay, well, we punched through. That was aggressive, but we'll snap back. We'll pull back below this. We didn't really go that far above. We're only like $10 in the money. That's manageable. I was feeling okay. It wasn't really too planned, but it wasn't really that bad off. Only $10 in the money. Then the week kept going, and we boom just gapped up, rocketed up here to the point where we were dancing in the 340 to 350 strike or price of the underlying. Now remember, I sold my call at 240, so we are $100+ in the money. So this automatically has me down. Extrinsic value aside, the intrinsic value in the option alone had me down over $10,000 on this trade. I only collected $1,400 when I started this trade. So, to then be down $10,000+ was, I have now 10x to my loss. And this is really where I started going, this is horrible. This is a huge drawdown. And this is where you want to just pull the ripcord and bail out and say, oh my gosh, let it go. Sorry, I missed it. I'll catch the next wave. But that's not my plan. My plan is, even if you're breached, you're okay with assignment. But you're not going to go quietly into that night and just let them assign you. So what I do is I wait for the week of expiration. I wait till we get closer to the day of expiration, maybe the day before, maybe 2 days before, and I'm going to roll that call that's been breached, or that whatever option it is. In this case, it was the call that was breached out in time. And I'm going to do that again and again. So let's just temporarily forget about this red box that goes through this gap. But that's what each four of these red boxes are. This was a roll to the next month. We were still in the money, roll to the next month. We're still in the money, roll to the next month. Now, finally, we've fallen out of the money, which is where we're at today. But every time you roll, because you're maintaining the same strike and you're going further out in time, you will always, always, always be able to collect more premium for that roll. So what is up with this box here? Because this was such a swift and strong punch through, I did what's called go inverted. And what that basically means is I came in and I sold a put, but I sold the put above my call, which is a really weird thing to do unless you're planning on not coming back down below that put or below that call anytime soon. And you have to remember what that actually means. That means I am willing to buy shares of the coin for $280, which is where this strike was. Well, I also sold an option down here at the 240 strike that said I'm willing to sell it for $240. Sounds kind of weird, right? Why would you be willing to buy something at 280 and then turn around and sell it at 240? You're locking in a $40 loss per share. Well, the reason you do that is because you're going to collect more premium and you're kind of banking on the fact that you're going to stay above this put. If you don't, then you just roll it. And so it's kind of the same strategy, except I'm overlaying an additional put with that. And I was able to get out of this for, no cost at the end. We were still out of the money. And so I was able to collect that extra, I think it was like $1,700 simply by going inverted for this period of time. That helped me burn down the big loss that I had. And then I just kept rolling this call forward and forward and forward. So let's take a look at the matrix here on how did this actually look like when I pulled in the premiums. So remember, originally this was a volatility trade pre-election. It was just supposed to be a quick theta burn, quick volatility contraction, but we got blasted and destroyed by plowing through the top side. I did go inverted for a little bit to try to work down that debt that I had taken on at the very beginning, and then I went and rolled and rolled and rolled. So right here you can see on November 1st, that is when I sold my strangle. I collected the 1432, and we massively breached my strike. And that's where I paid $75.38 to close that, which is a huge loss, right? I booked $6,106 loss. Remember, this whole trade started out as just a $1,400 gain. So yikes, that's not ideal. And I rolled it out in time. This is also where I went inverted. So this November 13th is where I went inverted. And you can kind of just pause on that because it doesn't show you that premium I ended up collecting by going from this call that expired in November to the call that expired in December. But this one, like I said, I was able to sell it for $17.34. close it out for $0. It expired worthless. So I was able to collect and burn down just 1734 against that 6106 debt that I had. When I rolled the call, that's where I closed it at 75.38. The next one I sold was 79.45. So that $4, that is the extra premium that I collected by simply going out in time. Now, you might think, well, $400, that's not much against your $6,100 debt here. But every little bit counts. And it was only $4 because it was so deep in the money. So December 17th is when I rolled that. And I kept this one open. The price started declining. I was able to close this out for $30.17, book in another $49.28 against my debt on the house here at $6,100. Again, I rolled this out, and let's gotta look diagonal. So I closed this for $30.17, sold the next one for $42.42. So this $12 premium, I just now burned down another $1,200. Now this also moved in my price favor. So I was able to close this one out for $22.40, booking another $2,000 against that 6106 debt. Rolled this again because I was still in the money. So, close this out for $22.40, same strike, 1 month out, sold it for $31.70, another, $800, $900 more, burning down, chipping away at that 6106 debt. Now, as of Friday's close, last week before this recording, it closed. This was out of the money, and I could close it out for $5.05. Now, I didn't yet, but if I did, I would have booked another $26.65. So you add up all of this stuff, including your starting off debt of your 6106, and you will arrive at a net credit to my account of $5,223. It's pretty cool, huh? Well, you might say, well, yeah, but you had huge buying power expansion. And it's true, I did. This trade opened up. It was only like $4,500, $4,800 of buying power to get your 1432, which was pretty cool, pretty good. But because I went so deep in the money, I went $10,000 of notional value into the money, actually more than that. The drawdown on my account ended up being around $20,000 to $24,000. And so when I calculate my return on capital, I have to take that into account, because if I didn't have that, they wouldn't have let me hang on to this. They wouldn't have let me keep rolling it. They would have liquidated me. And so this is the return on capital. My capital expanded to 20,000. So I ended up returning 52.23, still about a 26% return on capital. Not too bad. But you might say, well, Jeremy, you did that in 2024. So how is that so great? Well, even if you take that from November 1st to assuming I close it out now, or a little bit, next week, you divide that out. That's still about a 6.5% to 6.6% monthly return. So that's pretty good considering, the Fed rate is what, 5%, 4.5%, something like that, annually, not per month. So this is returning on capital that's 6.6% monthly. And that really is my plan of just this constant income-based trading style where I'm selling premium. You have to be okay with assignment, but you're going to just roll. You're going to roll because every one of those is a net credit. And you can see over time, you stick to it, the price does kind of come back into that. And if it doesn't, you're just chipping away at each month that you end up rolling that. So that brings us to the end of this week's episode. Really wanted to just touch on that perseverance, sticking to the plan, have a plan and stick to it. Know your exit, know your entry, know what moves you're going to make when price does X, know what moves you're going to make when price does Y. And having that methodology, that mechanics, that trading strategy before you go in is oh so important, because it helps you keep emotions out of it. Because I can tell you, in my early days of trading, if I would have opened that thing up and see myself go from plus, $1,000 to minus $11,000, my psyche would be absolutely rattled. And that is where kind of doing this and the experience of this and planning for it and keeping buying power around for that expansion and understanding the mechanics of what's going on under the hood are so important, because it's that knowledge that allows you to take a deep breath, realize it's not the end of the world, and you plan for this. You're aware that this was always a possibility. Even though it's the worst case scenario that you could pan out, you still had a plan for it. And that is really important, I think, for everybody getting into trading is experiment, figure out what your strategy is, figure out what your plan is. Start with small dollars, start with paper trading, develop that. I've been working on my premium selling here for a long time. And I have a hard time with that because I don't want this to sound like the only reason I can pull this off is because I've been doing it since 2019 to since 2020. That's not true. I really have been doing it that long, but that just is when I refine it. And when I refine it, I was having these percentage successes much earlier on, but I didn't have the confidence to stick to the plan. And so I would get down, $500, $1,000, and I would start to freak out and bail and abort my plan. And so just with the time, seat time in the strategy, I've grown more comfortable with it. And so not saying you have to be comfortable with it. And I'm not saying that you should just, grit your teeth and stick with it and just copy me. That's not what I'm saying at all. What I'm saying is whatever your strategy is, develop it, hone it, trust it, lean on it. And it will serve you well. And yeah, you're going to probably in the process of learning it, not everything you come up with is going to be great. You're going to find things that really do really well for you. You're going to find things that might do well, but you don't really like. You might find things that don't do so well, but you like, and just keep refining it until you find that balance of what works for you, your trading style, your comfort. Because let me tell you, when you hit your comfort zone and you hit your comfort style, this is absolutely effortless. You just get into a routine and it's like hitting the gym, rep after rep after rep. And it just becomes second nature. So hopefully you found a few nuggets of useful information in this week's episode. I'll bring a couple more of the trades in the future of what I went through, how it panned out. But until then, good luck out there. I hope you're finding a market that you enjoy trading in, a strategy that you enjoy participating in. And remember, think outside the block.